Welcome back to the Neuro Finance Masterclass. We're officially on day 45 of the 365 Days to Financial Freedom series. And today, we're exposing the ultimate silent killer of wealth.
Yeah, we're talking about corporate debt. So today's theme is the balance sheet and hidden corporate debt. Because look, here's the profound reality that really separates the amateurs from the masters. Profit means absolutely nothing if a company is quietly drowning in debt. So we're going to put on our X-ray glasses today and look deep inside the financial machinery of the market.
Right, so here's our roadmap for today's explainer. First, we'll strip away the corporate facade, decode the balance sheet, uncover the silent wealth killer, give you the architect's X-ray tool, and finally, we'll finish up with your daily detective mission.
Okay, let's jump right into section 1, the corporate facade and the illusion of profits.
You know, amateurs get so easily distracted in the markets. They see a company showing off a sleek new product or reporting these massive global sales on their income statement, and they instantly think, wow, this is an absolute winner, because they're only seeing that revenue rolling in.
Exactly. But true architects, the deeply investigative minds we're building in this masterclass, they know the reality. Focusing only on revenue, well, it's exactly like looking at someone driving a brand new leased Ferrari and assuming they're incredibly wealthy. You're completely ignoring the fact that they might be drowning in high-interest credit card debt just to make those monthly payments. A highly profitable company can secretly be a ticking time bomb.
That is exactly why the architect completely bypasses the flashy income statement and goes straight to the balance sheet. Because simply put, the balance sheet never lies. It shows you true reality. Which brings us to section 2, decoding the balance sheet. Or as we like to call it, your financial X-ray. So, a crucial point we have to clarify right out of the gate here. A balance sheet is not a summary of how a company performed over a whole year.
Right, exactly. It's a snapshot. Think of it like freezing a company at exactly midnight on December 31st and taking a full-body financial X-ray. It captures exactly what's healthy and exactly what's broken right in that frozen fraction of a second.
And this gives us the perfect skeleton of the company, neatly divided into two perfectly balanced sides. On one side, we've got the assets. That's literally everything the company owns. The cash sitting in the bank, physical factories, inventory, and even invisible value like their patents.
And then, perfectly balanced on the other side, we have the liabilities. This is everything the company owes to someone else. We're talking massive bank loans, unpaid vendor bills, and long-term corporate debt.
Now, the math here is beautifully simple. When you take everything the company truly owns, its assets, and you subtract every single thing it owes to the outside world, its liabilities, you're left with a very specific, incredibly important number. Yep, that number is your shareholders' equity.
And this final number, shareholders' equity, well, it's the holy grail for the neurofinance investor. It represents the absolute true net worth of the business.
Right, because it's what actually belongs to the owners, which, by the way, includes you if you hold the stock. Think about it like this. If a company sold off every single factory today, drained its bank accounts, and used all that cash to pay off every last bank loan and unpaid bill, the shareholders' equity is the pile of wealth that's left sitting on the table.
All right, moving on to section 3, the silent wealth killer, boom, bust, and bankruptcy. So here's a deeply investigative question we all need to ask ourselves. What actually happens to a company that's surviving purely on cheap debt when a recession finally hits?
Yeah, because when the easy money stops flowing, the mask comes off. The true financial health of the corporation is completely exposed to the brutal light of day.
Let's map out exactly how this plays out in reality. As we discussed back on day 41 of this series, the cycle is vicious. Look at year 1 during an economic boom. Interest rates are incredibly low, money is practically free, so companies borrow massive amounts of cheap cash.
Right, and then by year 2, they use that debt to aggressively expand. They build shiny new factories, launch huge marketing campaigns, maybe even buy out their competitors.
To the amateur looking at the income statement, oh, profits are soaring and the stock price absolutely rockets to the moon. But then, year 4 arrives. A recession hits the broader economy. Sales abruptly drop because consumers stop spending. Suddenly, the company isn't generating nearly enough cash to even pay the interest on those massive loans they took out back in year 1.
And that, unfortunately, leads to year 5. The banks come knocking. They want their money back. The company is forced to file for bankruptcy, the stock goes to absolute zero, and the amateur investor, who, remember, only ever looked at the profits, loses absolutely everything.
Okay, let's look at section 4, the architect's X-ray tool, the debt-to-equity ratio. So, to avoid that deadly trap we just talked about, we use a very specific, deeply empowering tool called the debt-to-equity ratio.
Now, I know it sounds highly technical, like something only a CPA would use, right? But it's really just a plain English translation of a company's leverage. It simply takes those total liabilities we just discussed and compares them against the actual net worth, the shareholder's equity.
Exactly. It tells you, in plain terms, exactly how much of the company's day-to-day operations are being funded by the bank versus how much is funded by their own actual organic wealth. So, if you see a high ratio, that flags a dangerous ticking time bomb. It screams that the company is aggressively surviving purely on borrowed money. I mean, if a breeze blows the wrong way in the economy, they're gonna collapse.
Conversely, a low ratio reveals a financial fortress. It shows a company standing on a mountain of its own hard-earned cash, completely insulated from the demands of greedy bankers.
And you know, Wall Street elites, the truly sophisticated players in the market, they don't just blindly buy profitable companies. They specifically hunt for these financially bulletproof fortresses.
Exactly right. They actively avoid businesses surviving on a lifeline of borrowed money. Instead, they look for those low debt-to-equity ratios that guarantee a company can weather any economic storm and just outlast their overleveraged competition. And the best part? Now you possess the exact same analytical tool to do the same.
All right, let's wrap this up with Section 5, your financial detective mission. Today's action plan.
It is time to turn this theory into your cognitive task for today. Step 1. Open your financial app of choice.
Step 2. Look up the exact same company you researched for yesterday's task.
Step 3. And this is key. Ignore the shiny charts. Click right into the Financials tab and open the balance sheet.
And step 4. Scroll down to the liabilities section and find the company's total debt. You need to see with your own eyes exactly how much borrowed money is propping up their operations.
Remember this deeply undeniable truth for your investigations moving forward. When you buy a stock, you aren't just buying their profits, you are inheriting their debts. So I want you to look at your portfolio today and ask yourself, are you truly comfortable with the hidden debt you own? Or are you holding on to a ticking time bomb just waiting for the recession to hit? Keep building that X-ray vision, and we'll see you tomorrow for day 46 of the 365 Days to Financial Freedom series.